Yes, Rishi, you're live.
Okay, great. So, good afternoon, ladies and gentlemen. And I'm really sorry. I really apologize for this inordinate delay due to a technical glitch with our previous platform. So we've had to migrate to the Zoom platform for this event. I am sure your wait will be worth it. Today we have a lot of speakers with us. We have Mr. Manish Bhandari from Vallum Capital. We have Mr. Puneet Singhania, Director, Master Trust. And we have Mr. Shivanshu Mehta, Head Bullion at MCX.
Take it.
And I am Rishi Nathani, Head Business Development and Marketing at MCX. So whatever we could have shared in 1.5 hours, we will try to share it in the next 1 hour with you. And I just hope that you will get the essence of whatever we wanted to share with you. So I just wanted to touch base on commodities and the importance of commodities in our lives and how gold is important as a commodity. So basically commodities as an asset class are very unique because they give you the advantage of physicality and tangibility along with financialization. When I say that, let me explain it in the simple terms that when you buy an equity share, it is dematerialized, which means the equity share has been destroyed and an electronic balance has been created. Similarly, in commodities, you also get dematerialized commodity warehouse receipts, but the actual commodity cannot be destroyed. It is there physically. So you have the choice to take the delivery of the physical commodity directly or to keep it in the warehouse, get a warehouse issue receipt issued, dematerialize that and trade the commodity in demat pool. So it gives you the best of both worlds. Second point is adding commodities to a portfolio will reduce your standard deviation of the portfolio and reduce the risk of the portfolio. And commodities over the long run work very opposite to equities and bonds. So in the portfolio, it will help when equities and bonds don't do well, commodities ideally do well. And at the time when they both move in the same direction, also the movement is very different from each other. Also, commodities do well in times of inflation where equities, bonds don't do well, and so on and so forth, because commodities are a natural hedge against inflation. Now we have soft commodities, agri-commodities, and we have hard commodities like metals and bullion. Now today we are here to talk about gold and bullion. And the advantage or the lure of gold, we've seen that gold prices have been rising, silver prices have been rising, and I attribute most of this to the fact that globally the governments are printing more money. They are going on an expansion in terms of monetary expansion and loose money policy. This is also helping gold and silver to move up. For more details, I will hand you over to Mr. Bhandari, who will take you through gold as an asset class. Over to you, Mr. Bhandari.
Hi, good evening, everyone. And I bear a disproportionate burden today to make up for the timing loss what we have. But I hope so with the end of this presentation, I'm sure it will be an insightful journey for next 35-40 minutes or so. So let me begin with this a brief presentation which I prepared for this evening today. Is a gold rally, how far, how long? Can everyone see this on our screen, Puneet? Everyone can see this?
Yes, Manish, please continue.
Wonderful. So our agenda is a gold rally. All of us are mesmerized by this gold rush, what we have seen in last 1 year or so, maybe accelerated in last 3 months, 6 months, but for last 1 year or so. So our agenda is what is gold rally about? So this is a four-legged, four-pillar, which on what this gold rally is resting on, and I will take you through these 4 pillars in detail. So the first one is the money printing by the central bank, the gold demand and supply dynamics, the role of China, which during my research I got to know about the role of China in the gold price movement. And finally, it is the influence of the real negative interest rate, which has influenced the gold prices for so long. And that would also answer you that how long and how far, okay? So let's start with this chart, our evening with this chart. Is there's unprecedented expansion in the central bank balance sheet. And what does it mean? You have heard about the money printing, and that's one of the most talked about word in the last few months or so, post in the post-COVID world. But let's put a tangible value to this. Is that the Federal Reserve balance sheet has expanded 7 times in the last 10 years, and I'm just looking at a log scale of a 10 years. So close to 7.15 trillion US dollar. And if I have to add up the four biggest central banks of the world, the Federal Reserve, Bank of England, Bank of Japan, and the ECB, the total balance sheet size has increased by 5 trillion US dollar, which is close to 45% expansion in last 6 months or so. And that explains the magnitude of the balance sheet expansion which has happened. And balance sheet expansion is, for a layman terms, it's the money in the economy. Whether it goes into real economy or it goes into the financial economy is a separate issue, but that is the money in the economy which has been printed by the central bank to fight the COVID situation, unprecedented COVID situation. To give you another idea, interesting idea, is that what does it mean for gold? So if you look at in history of last 15 years or so, the gold reserves as the percentage of the Federal Reserve balance sheet used to be close to 15% and went all the way to 25% before the great financial crisis. And they are today just 6%, less than 6% as a percentage of the central bank balance sheet. So the balance sheet of the central banks today are not backed by the gold. And that is one of the most important pillar. In 1971, 15th August, that's an interesting date, we share Indian shares with the rest of the world. That was the day when the gold peg was removed from the US dollar, and the US dollar became a non-gold convertible currency. And since then, we have seen a huge expansion in the monetary side in the global financial markets, in the central bank's balance sheet. So that gives you an extent of the magnitude of the problem in the process. This is an interesting one. What does a central bank expansion does it to the currency? So US dollar has started declining for last 4 months or so, 3.5, 4 months or so. And coincidentally, a US dollar also follows a 12-year cycle, 12 or 13 or maybe 11 or 13-year cycle. But let's take an average. It's a 12-year cycle where a dollar sees an up cycle and dollar sees a down cycle. So this is a chart from 1971 onwards, which gives you an indication that how dollar cycles have played out. And I will come to you in a subsequent slide that what does it mean for the gold prices. But it is very important for you to understand that dollar follows a cycle, and these cycles are a 12-year cycles. And now we are in a declining cycle. We have started a declining cycle, which could continue for next maybe 3 years to half a decade or so. So in that context, it is very important to understand that where is the dollar position, and one of the reason for the dollar cycle is the expansion in the central bank balance sheet, unprecedented expansion in the central bank, U.S. central bank balance sheet. And why dollar is important? Because US is the world reserve currency. 80% of the global trade takes place in the US dollar, and 52% of the global reserves are in the US dollar. So dollar is an alternative to gold. And that's the reason declining dollar cycles or an up cycle does influences the gold prices significantly. And this is a chart which says you that dollar has an inverse relationship to the gold price cycle. And what we have seen since the market got a whiff of the declining dollar cycle in the last some time frame, and that's the reason you can see that how the gold prices have started behaving up, and they have accelerated in the last 4 months or so. So this is one of the most important pillar, talks about that how dollar influences the gold prices, and which is very important because gold is not something which I and you buy can influence the prices. It's the global monetary order, global monetary cycle, central bank balance sheets, and host of other things which influences the gold prices. So the thing to note here is that a declining dollar cycle has an inverse relationship to the gold prices. With this, I come to the next point on the next agenda here, is how is the gold demand and supply. A lot of people do make a comment, it's a commodity, it's a yellow metal, it's a shining commodity. So let's see the demand and supply. So usually, and any other commodity like iron ore or coal would see a huge expansion in the supply side. But as one of the most sought after commodity or sought after metal, gold has not seen any significant expansion in the last 10 years in a row. This slide talks you about that how the supply increase in the gold in the last 9 years or 10 years time frame has been just a meager 1%, just 1%, while many other commodities have seen a significant supply side addition over a period of time. But if you look at a gold as a supply situation is just a 1%. So this I can conclude here is that it's a commodity which is in very short supply. It's in a short supply, and in a situation when the global monetary disorder has taken place, a commodity in a short supply is a commodity which is valuable, if you have to call it a commodity by any chance. This is an interesting table. I did pick it up for you. Is that a lot of people do ask about is a lot of people who are in business do make this observation that the jewelry sales have been declining for some time, and this does influence the gold prices. Answer is yes. But what has changed in the last 15 years or 10 years time frame, and if you look at over a period of cycles and the blocks, is that the demand for bars, gold bars and gold coins have replaced the demand for jewelry. The demand of financial product as a gold has changed the nature of the consumption of the gold. So earlier it was the jewelry, maybe in our mother's time it was a jewelry, and now in our time, in the millennials time, it is the demand of the financial product which is making sure that the gold find its place. So people don't want to use as only jewelry as a proxy and a medium. So if you look at this chart, and if you look at this part of the table, it says that the demand for the jewelry has been taken over by the demand, has been substituted by the demand of bar, coins, and the exchange traded fund, which owns gold in the process. So that gives you an idea that the gold demand is very much there, but the form of the gold demand has changed. And since we are talking about the demand of the gold, this is very important. One of the biggest buyers of the gold in the world are the central bankers, the Bank of Japan, the Bank of US, the Federal Reserve, the Bank of Germany, the Bank of England, and many so on and so forth. And if you look at the gold purchases by the central banks for the last 2000 to 2009, we have seen sale of the gold by the central banks. And from 2010 onwards, we have seen a complete reversal of situation of the gold by the central bankers, and which means that in 2019, we have one of the highest purchases by the central bankers, and cumulatively it's significantly high. So what does this tells you from the purchase and from the demand point of view is that there is a demand, a significant demand, and now central bank owns close to 35,000 metric tons of gold in the process, and which is one of the highest in this recent times. And also look at it from a perspective of what are the alternatives to the gold for any of the central bank. It's the US Treasury. And today the yield on the US Treasury, the competing product to the gold, is the lowest in the history, 55 basis point, 50 basis point, and it has been coming down. And that's the reason you have seen a huge bond rallies for some time or so. So what does it indicate you is today is that the sovereign credit risks some kind of risk to the portfolios, and there is only one alternative for the central banks, either to find another round of sovereign securities looking across the globe, or to find gold as an alternative. And people will choose what is more convenient to them and what they have believed and what has held as a trust and belief for years and years together. This chart tells you about the change in the gold demand in the last 2 years, and I just made a point that the decline in the jewelry has been made up by the central bank buyings and the ETF buyings. So the gold demand has remained the same or maybe slightly inched up, but it has not disappeared by any chance in the process. I come to another interesting aspect is the production. The gold production has seen a decline in 2019, and we have just seen an increase of close to less than 1% on the annual rate in the last 3 years. So the point I'm making here is the production has not caught up, the demand has remained same, and there's a huge potential demand environment by the various central banks, which is there. and by the other participants. So you have a perfect situation where a gold demand and supply remains very tight by any sequence. Why this is important? In most of the other commodities, we have a situation where the rise in the prices do meet up with the increase in the supply, and which is not the case in the case of the gold. The supply increase is not happening at the pace where the price increase is happening, and nor do I see a chance where the supply increase can happen. In the last 15 years, there has been no new mine of 50 million ounce, which is a sizable mine by the gold standards, has been found, or maybe no 30 million ounce deposit has been found in the gold, in the gold, and only one few 15 million ounce deposits have been found. So what we are making a case here is that this is a very strong pillar where the demand for the gold is there and the supply is not keeping up pace in any chance by any case. And this is some slides I did pick up for you in terms of that the production reserves have gone down substantially in the last couple of years. And this was also in my previous slide, that there's no new supply which has come in, no new discovery which has happened of the gold. And what has happened is depleting resources and depleting resources. So we have seen a situation where the world was worried about that the world will run out of oil. I'm sure at some point of time world may run out of gold, which looks far more a proposition versus a world running out of an oil. What this is a very interesting is that usually the financial investors do move in looking gold as an alternative whenever the price rise happens, and which is a momentum. And if you look at somewhere in 2010 and 12, you saw a huge upsurge in the prices of the gold, and as well as in the exchange, financial flows through the exchange. And in the subsequent 6 and 7 years, we saw a decline in the prices and decline in the financial investments by the financial investors. And now we are seeing the reverse of situation. As the price moves up, the more financial investors converts their assets into the various other forms into a gold. So this is a completely, as the gold prices goes up, more money chases the gold in the process. I come to the third leg of our third pillar of our gold price movement, a very strong pillar, is what has been the role of China in this gold price movement. It has been very less talked about, but it throws some very interesting analysis, the role of China. If you look at it, the share of China in gold demand was close to 10% in 2000 in gold jewelry. Today in 2019, it is 36%, significant, of the total demand in the world, of the total jewelry demand in the world. If you look at the share of China in bars and coins in 2000 year was 5%, today it is 28%. The share of ETF, which is just called the fancy in China, the gold ETF, which used to be 0.5% in year 2010, has gone to 3% in 2019 as a percentage of total ETFs. And if you look at on overall the consumption, overall consumption, it is 10%. On 2000 has gone to 33%. So this is a marked change which has happened in the way China sees the gold as an alternative to their assets, and they have just caught up to the fancy of investments in gold, which was not a culturally the way India was over a period of time. But India, in terms of the jewelry demand, has given its way to China. Look at this chart, which says that China used to have consumed demand close to 676 tons in 2010, and it has taken over. And while India was 1,000 tons, and 2019 the roles have reversed, and China is close to 900 tons, while India is 690 tons. So we all get married to idea that it's a culturally India has looked at a gold as an investment, but this reminds us, all of us, that it's a China which has started looking at gold as an investment, and it's a big tactical shift in the process. This chart gives you an idea about the gold production, which China has used its technological prowessness to increase the gold production. And if you look at this gold production in the below table, it used to be 225 ton in 2005, and this in 2019, that's the latest available calendar year data, it is 420 tons. So they have matched up with the demand side, also with the production side in the world. And so they don't want the gold to go out of China, which is very, very important for us to know. And today they are consuming close to maybe 1,000 tons, and close to 60-65% is imported from the world part of from the overall part of the world, and 33 is indigenously produced in the process. This comes this I bring you a very interesting thesis, is that is Chinese currency managed against gold versus a US dollar. For years and years together, Chinese currency is still a peg against a US dollar, and they keep on adjusting the peg against the US dollar. But what I see now in last year or so, maybe year and a half or so, is that Chinese currency has become less volatile and is moving in a direction in the way the gold is moving. This has a lot of geopolitical significance, that if China is able to manage a currency which has got a volatility which is closer to the gold and which runs closer to the gold, then you have a lot more people who will believe in the Chinese currency, and that fits into their geopolitical ambition of replacing US dollar in next decade or so as one of the favored currency in the world. And what does it mean is that huge demand of the gold, because what does it mean in a plain simple language is that you exchange your renminbi against a fixed parity of a gold. Has it happened now? Answer is no. Can this happen in next a year or so? Answer is yes. At some point of time, answer is yes. I do see that happening, but at least the sign is there in front of us to wake up to this new reality that the Chinese currency is getting managed against the gold. And maybe when you go back home, you should see this data far more clearly in the next year or so time frame. So with this, we conclude that what are the demand and supply of the gold as a dynamics, the money printing, how it has helped, how the dollar has helped, and the role of China in the gold price movement, the fundamental drivers. Now I come to most interesting part of what our presentation today is, the influence of the real interest rate scenario on the gold. And that will also explain to many of you that how the gold and why the gold has moved up in the last one and a half year or so. So look at this chart. The gold has a performance completely corollary antithesis to the negative interest rate in the environment in the world. What does a real negative interest rate environment means to all of us is when the inflation is significantly higher than the treasury yields, what you can earn, a risk-free to a risk-free asset, a risk-free liability. So you see a situation where it has happened on a couple of occasions in the world. In 1974, where the gold prices shot up and you saw a negative interest rate. This is a US negative interest rate. Then in 1979 also we saw that, and we saw a huge movement in the gold prices. In the last 2 decades, we have seen the inflation systematically coming down because of the globalization. And as the interest rate benign interest rate happened, we have seen the movement in the gold. And the gold movement of 2010 and 12 was also marked because of the real interest rate going negative. And now we see situation again coming back in the last 3 months or time frame or so, where the treasury yield has crashed and you are seeing a real negative interest rate environment and the movement of the gold price. Nothing explains better the movement of the gold prices versus the real negative interest rate environment. This is one of the most interesting table I have come across and I wanted to present to you all, is that look at the periods of the negative real interest rate. And let's take United States as a proxy, because dollar is a currency which everyone would weigh as an alternative to a gold or maybe any other gold standard currencies in the world. And look at, there are 5 instances: 1973 to 75, 78 to 80, 2007 to 2008, and then 2011 and 12, and to August 2019 onwards to July 2020. These are the time frames when we have seen the negative real interest rate in United States of America. And the duration is also that sometime it was duration for 23 months, 24 months, and then 10 months, 19 months, and now it's been close to 12 months. Where on a break-even level, now we are moving to a negative interest rate scenario. And what is the return of the gold during this period? So if you were able to predict a negative interest rate scenario 6 months ahead of the cycle and the timelines what we have discussed here, and you held it to the 6 months after the negative real interest rate even turned positive, you made 52% return in the gold during that time frame. During those 23 months, 6 months add here and 6 months you add here. So this is like 6 and 6, another maybe 34 months or time frame. And look at the situation in October 2078 to 80, you made 183% return in a gold in those period of 24 months and another 12 months or so. Add up another 12 months, 6 months before and 6 months ahead, and so forth and so case. And that explains you the gold price movement in 2019 to 2020, that we have started hitting the negative interest rate in last 6 months or so, 4 or 5 months, and increasingly market is getting convinced that because of the huge budget deficits in the global environment, when in the post-COVID situation, the governments are struggling with the revenues and they are seeing a huge budget deficit. We are going to see a negative interest rate cycle for a long period of time. And in that case, the gold is the asset to own for some time, or for maybe how long and how far is getting answered here. The gold will do well till the negative interest rate scenario will remain, and you can add a 6 months time frame more. And if you see a positive interest rate cycle by time frame where the interest rate cycle or the inflation has to collapse or the interest rate cycle has to go up substantially in the major economy like United States of America, then you will see the rally will stop, or maybe you will see some decline in the gold prices. And this is a time you look at the another table, subsequent table, after the period of negative interest rate, when the inflation, either reason inflation fell or because the interest rate were increased, the gold prices went down by 20%, and exception being one on 16% up, and then it fell down after some time, and then another 15% down in 2012 to 2013. So this becomes one of the most important chart for you to reconcile that how long this rally will and how far is it. Can anyone would be in a position to predict that where the gold prices will go on? Answer is no, but answer is yes, that directionally the gold prices will remain significantly at elevated levels, and more the possibility or the probability of going higher from here, significantly higher from here, is high till the negative interest rate scenario remains. And I am of a firm belief that this will remain for considerable period of time. I don't see a situation where the interest rate cycle can change. In fact, I see a situation where the inflation, because of the monetary printing, what has happened unprecedented, can come back again in a significant way, which is at the moment as 1.2% or so, and it can be a significantly higher. Then you may see further acceleration in the gold prices. This is an interesting chart. Is when in month of March, suddenly you saw a huge downward spike in the gold prices. And as I explained to you in my previous two charts, that why this the decline in the gold prices happened is completely because of the expectation that the real interest rate is going up and it is not going down. And in the month of March, you saw a decline in the gold prices, and it just remained for 10 days or so. And then the situation changed dramatically as the COVID progressed, as the response of the government progressed to the COVID, and it changed significantly. Gold has outperformed all the currencies. Very few currencies can stand against gold. This is a 20-year chart. If you put this against most of the currencies in the world, gold in dollar terms have outperformed each and every currencies in the system. And that is how the gold has outperformed all the major asset classes in the last 20 years. Whether you are talking about, if you're an Indian investor, you are talking about BSE Sensex or XYZ, and in some form or others, gold has done very well in the process. We at Vallum has looked at a gold, investing in a gold, and on two occasions we spoke about investing in gold in 2018, 19, and 2019 and 20. And for some of you who are more interested in this, can go on our website and maybe look at the shareholder letters in detail. And with this, I conclude our conversation today. As in a summary, the world is awash with money, an unprecedented amount of money. And the world is looking for an assets which is in short supply. Apart from a gold, a case for the paintings of the Leonardo da Vinci can also be made, or any of the paintings which is in short supply and which will not lose its value, it can also be made. But yes, the world is looking for in abundance, where the money is in abundance. The world is looking for an asset which is in short supply. Gold is an order declining dollar, and central banks are full with the RBI, and at some point of time they need to make a tactical allocation to the assets, which is completely antithesis to the US dollar. And as I said during the course of our conversation, in the times of the real interest rate, this is the most important point, negative interest rate, the gold which the reason is the gold has a carry cost. So, and the carry cost is also the treasury yield. So it competes with the US treasury yield as an asset class. And if you have the situation, and if this situation has to reverse where the carry cost has gone negative and the treasury yields are significantly lower than the inflation which is running in the economy, then you have a gold which ideally should do better. And it is for years and years together, it has preserved the purchasing power of money in the decades and decades and centuries to come. And that's what has come back again today as one of the golden moments, as we all say, and Goldilocks moments for the gold. Thank you. With this, I end my conversation and my short presentation, and I hope I was able to make justice to the discomfort you had in the start of our conversation.
Thank you. Thank you, Manish. Now I would request our head of bullion products, Mr. Shivanshu Mehta, to now take you through his presentation. Shivanshu, over to you.
Yeah, thanks Rishi, and thanks Manish for a rather elaborate presentation, taking care of all the fundamentals. That makes my task very easy. Listeners, frankly speaking, the backdrop has been very carefully crafted by both the earlier speakers. Very clearly, negative interest rates, geopolitical tensions, tariff wars, unfolding recessionary trends globally, and a history of the previous play of such variables from 2008 to 12 to boot. There has been a massive interest, hence, in this asset class, especially around the time that the lockdown began, when we had gold at around 39,000 rupees per 10 gram and silver at 35,000, and the gold silver ratio was being talked about at 125. And today the scenario is much different, and hence there is tremendous need for investors to diversify, to include commodities in their portfolio as a measure of not only return but as diversification, safety, lower beta, and so on. So you need a vehicle. So basically, what are the vehicles that you have if you really want to achieve this objective is what I'm going to talk about. Bullion derivatives, as you know, MCX has a long association with bullion. We have about 99% of the market share in futures of bullion, silver and gold. We have a variety of products, and we'll try and take you through those products and those important facts which you must consider as retail participants. So focus will be on retail today, and I shall just start to share my screen, please. Yes, so is visible to all?
Yes, please go ahead.
Yeah. Or should I make it full size? Is that the better preferred way? So as you know,
Shivanshu, make it full size.
Yeah, this is full size. So as you know, a little bit about price. So price and liquidity are two very important assets of an exchange when we talk about any successful contract, because a successful contract has to have participation of all constituents, not only speculators, not only traders, but physical industry, hedgers. And as you know, MCX today is used by the entire bullion value chain, from government nominated agencies for import, other importers, traders, jewelers, including listed jewelers, etc., refiners. And why they are able to do so is because our price as such is a comprehensive hedge. It includes the international gold prices, the currency exchange rate, as well as the custom duty tariff. And hence, in an INR denominated format, not only does it have an excellent correlation with the international prices, let's say the CME, but an equally good correlation with the domestic spot prices, and hence it becomes the perfect vehicle for both hedgers as well as speculators or traders or investors for that matter. Because of this correlation and the sensitivity to movement of international prices, currency, as well as the custom duty tariff, which changes twice a month. And this sensitivity is created not over a day, it is created by virtue of a diverse participation. That the moment disparities emerge, they are immediately neutralized by the market. As you know, the trading hours and the geographical location of India, you're well aware that we get to see the gold markets across the world, from Stockholm, Japan, to Shanghai around noon, Europe just afternoon, and going on to USA when the electronic markets of the CME open, and also covering the LBMA spot prices, and ultimately closing after all of this is MCX. So it caters to the entire global sentiment and movements, etc., which gold sees. Just to enumerate to you why we call gold a portfolio diversifier, and this is primarily being shown, it's an empirical reality. Only empirical facts are being shared here. It is not to solicit any direct or indirect participation. The issue here is that it's very important for the safety of investment for investors to know that a single asset portfolio would give how much return versus a portfolio diversified with gold. We're talking only about gold today. So let's say from, you can see from this table that June 15 to June 20, over the past 6 years, the return of gold has been captured here. And you've also got equity on the other side. And you've seen that even with a 10% presence of gold, you're able to get a return at the bottom right corner of 22%. Slightly aggressive presence to lower the volatility of the portfolio and yet ensure return. You see with 20% presence, 27.75%. And so managed futures, it has been shown, should be a particular percentage of the portfolio, and that portfolio return as well as risk around 20% mark. So I've given you one with the 15% also, that's around 25% return. So we've basically averaged out each year's annual return and shown you with a base of 10 lakh investment. So this is just a actual numerical fact which has been shown to you, that why gold lowers the beta, and yet over the years, as was shown in the previous presentation, it ends up giving you a higher return, be it any currency, because it captures inflation, it captures all kinds of risk perceptions relating to geopolitics, relating to currency wars, and relating to recessionary trends of the economy. And most important, the liquidity and the monetary easing which you are seeing today. It also it creates an ideal environment for gold to actually perform. Now coming to very quickly the MCX numbers. Last year was a stellar year. We had a growth of 102% over FY 18-19 itself, wherein we saw 91% overall bullion portfolio of futures. That's turnover wise going up over the previous year, and gold went up by 102%. And this year we continue to see a further growth over FY 19-20 as well. And we are at 16,600 odd crores per day on a single side basis when it comes to bullion. Gold and silver both are contributing, and you can see the July numbers at the right of the screen, which are even much higher. Now the average daily volumes at MCX, you can see 18 tons for the previous year, 1,000 tons plus for silver, and a healthy open interest on an average as well in both the commodities. Now coming to, again very quickly, just recent highs which MCX has hit, 50,000 plus crores of bullion turnover last week, and individual gold and silver turnover 7.5 year highs over the past few months, silver only a few days back. And the gold options, we have seen it come of age. It registered the highest volume of 9.5 tons as well as the highest open interest of 8.75 tons. In times of volatility, options is a beautiful product to be used not only by hedgers or physical players, but also by investors in conjunction with their futures positions in order to smother or smoothen out the risk as well as increase the return. And you can see, just as we speak, yesterday itself, silver options has registered a turnover of 642 crores, all-time highs there for silver options. Coming to the product portfolio that we have. So we have a product in each denomination of choice in gold and silver. In gold, all these contracts in gold and silver are deliverable contracts. And we have the 1 kilo contract. We have the mini, which is the 100 gram, a Guinea contract, which is the 8 gram coin. And we are the only exchange, our little bit at innovation, as a world record, we are the only exchange which has a 1 gram deliverable contract in the world. It's called the gold petal. And you would be happy to note that what used to be a turnover of 1.89 crores 2 years back, it is 20 crores today on an average in gold petal contract. And we have seen a delivery of 20,000 plus coins in just 6 to 7 months. So why I'm paraphrasing gold petal is because gold petal is an ideal retail product of SIP based accumulation. It is a product where you get tamper proof, high quality coins, and it is a product which can be taken in physical form as well as held in electronic form. And each coin comes with a certain, all products of bullion come with individual assaying certificates of the refiners which are approved by the exchange. So quality is a given, and the liquid order books of the exchange can be used best to do a weighted average for retail consumers in all of these products. And if you see, this is just a chart of the price movement, which already is a focus for all, but at the same time, the volatility is seen to be at around 19% in gold in 2020. You can see the chart of COMEX versus MCX in the top right corner. You can see an excellent correlation there. And at the bottom, you can see the gold volume and price chart of MCX. The high liquidity, low impact cost, depth of order book, high open interest, these are all indicators of hedging efficiency. And there is no diffidence in stating that at one point in time before the introduction of CTT, the impact cost of MCX was the best in the world, even better than the CME. This is before the CTT came in. Coming to silver very quickly, I know gold is the focus, but they go hand in hand. We have a 30 kg bar, we have a 5 kilogram contract, as well as a 1 kilogram contract. Both the 5 and 1 formats have a 1 kg silver bar as the deliverable product, which is again a beautiful retail item. And I just talked about this 35,000 and 125 combination of gold silver ratio as well as silver price of March. And it is not any strange coincidence that around the same time when we had made a silver 1 kg and 5 kg deliverable, we have already seen more than 10 metric tons of silver delivered on exchange via the 1 kg bar. So this again is a retail product, our retail offering, new offering, an immediate response from the market. I would like the retail investors to keep that in focus. Volatility in silver, you can see for yourself, 43% this year. As they say, when gold starts to ascend the staircase, silver takes the elevator. I remember in the Boston conference last year, I had heard this very clearly, and it rings, it just continues to haunt me. And when gold decides to come down the building, silver jumps out of the window. That's what they say. So, and you are seeing pretty much the first portion of it coming true. So silver options is a product which you must utilize for such volatile times along with the futures. This is the average volatility chart. So in short, if you are a firm who is in the gold business with a turnover of 1,000 crores, then 190 crore of that is at risk if you do not use the hedging platform of, let's say, MCX in order to take care of that risk. So on the whole, if the country is 75 tons of import, this is a previous year number, was seen around 2 lakh crores, then 38,000 crores of that is at risk without proper risk management. So what are the option products that we have? I talked about the futures already. This is the option products, 1 kg option in futures in gold, 30 kg option in futures in silver. They have both performed when the volatility is at peak. The gold mini 100 gram option in goods is also a product we have, as well as silver, which we are yet to launch, which will also we are considering launching. It's a 5 kg format. But the gold 1 kg and 30 kg are already seeing a very good healthy buildup of open interest over the past few years. And you can see the numbers at the bottom around daily volume of 1.46 metric tons in gold and 17.76 tons in silver. This is the previous year's average daily turnover. All these are FY20 numbers for the full year. 557 crores and 79 crores. Now the open interest is around 3,795 kgs in the case of gold options and 1864 in the case of silver options. So just to quickly show you that the portfolio margin benefit, see what happens is an exchange which has a vibrant futures contracts along with options contracts, that is where you can actually utilize the portfolio margin benefit, because this is something which actually creates a hedge between, a perfect hedge between your various positions at the least cost of margin utilization. Not only within the various option strikes do you get a netting of benefit, but also between the options as well as the futures portfolio combined. Margining is at that level, and I can tell you that as compared to independent positions, the cross margining benefit would take you to a level of about 50% of the margin requirement. So that is a healthy number for you to look at. Very quickly, now I'm coming to only the retail focused products. You can see gold petal 1 gram, delivery unit as well as trading unit, 999 LBMA approved suppliers. Coins are available to you, compulsory delivery contract, 2 days post settlement, post expiry for settlement, and a very clear and transparent 100 rupees making charge per coin, which is given by the buyer and passed on to the seller. Complete transparency, complete fairness over and above the price. Mumbai is actually the basis center, but additional delivery centers of Ahmedabad and New Delhi in this case. And it can be held, all these products in fact can be held electronically, accumulated, and as and when you want to take out delivery, you can. 1 kg in the case of silver micro, 999 is the purity. It's a bi-monthly contract. You can see that again the transparency, making charges are 400 rupees per bar, very competitively kept, and the proof of the pudding is actually in the delivery, like I mentioned to you, 10 tons plus already. Ahmedabad is the delivery center here. And like I mentioned, the only exchange in the world, so you can see the features mentioned here, which I have already told you about the product. Electronic holding via Commerce. Yeah, these are some of the numbers of gold petal from 2 crores, 1.89 tests, around 20 crores now, and silver micro 177 is now 1586 crores. 20,240 coins and around 10 tons, 6512 plus 3600 in the case of silver 1 kg. I'm focusing more on these products, while of course at any stage gold mini is also a retail product. 100 gram gold bar at about 5.5 lakhs, it keeps going up, is an equally important retail product for clients to look at. So is the 8 gram gold guinea, okay, depending on the denomination of choice, both are available. And the 8 gram guinea is also a product which has transparent 200 rupees making charges over and above the price. Deliveries at MCX, you can see 117 metric tons of deliveries have taken place and 3,451 in gold, in silver. And you can see that single month we had more than 5 tons of delivery in August. And the rest of the numbers I've shared with you already. So we are seeing about 10 tons odd per year, per calendar year of metal delivered. Delivery is something which is important for the retail point of view. And delivery is a proof of acceptance of price by all constituents. That is why I focus on delivery. The main purpose of a commodities exchange may still be risk management and price discovery, but also delivery, because delivery is acceptance of price and investment. Yes. Coming to options, why you should have options again in your portfolio, because it's an insurance, it's a one-time premium payment, and you're insured against downside risk. At the same time, you remain participative in the favorable side movement. This is the USP of options. And combined with futures, you can actually enjoy the leverage of futures with safety of options. Better cash flow management, especially for jewelers and hedgers, as well as clients who are, let's say, to give you a very simple thumb rule, as they say, when you long futures, you buy a put. So buying a put, you protect your downside. While if the futures goes up, you surrender what? Only the premium you paid, at best about 1% of the value. But futures continue to be with you on the favorable side. So some safety and hedging measures, and one such instrument which is very important is options. In fact, what you can do with options, there can be a gazillion ways. I'll leave it to the experts from the broking side to take you through that. But the pure hedging related strategies, because that's important for everyone to know. For example, the costless collar is a strategy which is used by miners globally, wherein they sell their expected produce calls above the money and at a certain price, knowing that anyway they are producing that gold, and they buy puts below the money to protect a downside. So one side, receipt of payment funds the purchase of insurance on the floor price. So it becomes a costless collar. You get one premium on one side and you use that to buy the puts by paying that premium. So flexible pricing schemes, some of the big listed jewelers on MCX, listed as in who are listed jewelers who are active on MCX, they are, as an example, using flexible pricing schemes for their customers. And this has been documented by them that in the walk-in customers, they are offered the lower price between, let's say, a 15-day period and the Diwali day actually, and any lowest price of the time period by the use of MCX options, by the use of buying puts basically. So this is something which the physical fraternity is doing, as well as other things like the traders, physical traders write calls above the money to do an inventory hedging. And as and when the spot to futures difference is high enough to further add a shield to that, they buy the physical stock in the spot and they sell calls above the money. And volatility, if you see the graph, the black colored background graph, volatility is basically the standard deviation of daily returns, and higher implied volatility typically impacts the premium of the option. Higher the implied volatility, expectation of volatility, higher would be the premium. Lower the volatility, it may make sense to buy options for hedging. Higher the volatility, higher the premium, it may make sense to hedge by way of writing options. Just a simple illustration to highlight that. The benefits of the Section 43/5 of the Income Tax Act, which says that commodity transactions undertaken in recognized commodity exchanges under the ambit of the SEBI and the Income Tax Act of 1961 says that the benefit of those transactions will be offsettable against the business income and loss and not be treated as speculation. This is important for the clients of our brokers who are running physical books, maybe jewelers or bullion traders, etc. Now, coming to the index, we are shortly going to be launching an index which is a bullion index, and it's titled MCX ICOMDEX. Well, very briefly, quickly, 70-30 will be the rough ratio of the weights, gold, silver right now. It is the constituents of the near month contracts, futures contracts, gold and silver, big ones, kilo and 30 kg. The advantage here would be that the contract value would be just about 7 lakh as compared to, especially today, when we are seeing the rallies in both the parent constituents, which is gold, silver, futures, and their value is, and the margins thereof are also in accordance. Here, so typically 7 lakh would be the value of this one contract. 1 rupee is the tick size, that's okay, same as us, as the futures. And initial margin is the same way as in futures, 5%, or it's a VAR-based number, whichever is higher. Cash settled. This is an important point to note. So basically this product, why I'm talking about here, is that in addition to the futures and options, in addition to the electronic and delivery holding, this product can actually get the portfolio money back into commodities for freshers, or even for people who want to do it in a methodical portfolio investment manner. Index is something which is sectoral in nature, representative of both the products, gold and silver. So if you're bullish on both the products, if you're bullish on bullion or bearish, whatever the case may be, you have a product which is cash settled, which is an actual index of their movements, which you can look at. And the very first or second slide which I showed, it becomes pertinent here, which I talked about, the diversified portfolio returns and lower beta, basically lower risk. So this can be a vehicle for that type of an approach. And of course, there is plenty of arbitrage, risk management, hedging arbitrage between the futures positions as well as the index to be. That's primarily what I had. And at the end, we'll be happy to take any questions. I try to breeze through it and considering that we lost some time. Thank you.
Thank you, Shivanshu, for your detailed views on the bullion and the gold contracts on MCX. Now over to Puneet from Mastertrust, our members, where he will share with you his thoughts. Over to you, Puneet. Shivanshu, can you stop sharing?
Yeah, so Rishi, if I may, can we do the Q&A, because we've got some interesting questions which have come up, and then probably towards the end I could speak for 2 minutes and make a closing, if that's okay with you.
Go ahead, you're visible and audible.
Can you hear me?
Sorry, is it for me?
No. Manish, there are a couple of questions, some interesting questions.
You're audible and visible. Please go ahead.
Okay, there are a couple of interesting questions which have come up. One is from Mr. Ashish Sood. Can you see it in the Q&A box, or should I speak out for you?
I am just trying to see this.
So here is the question. He says gold is a non-productive asset, so why should it be considered as an investment option? Why,
Oh my God.
why is it a hedge against inflation? And of course, with inflation expectation, he believes are low considering the COVID period. So why would be a reason for gold to go up because of your expectation that the inflation is going to be higher?
Yeah, so there are two parts to this question. One is that gold is unproductive assets, and why one should look at gold as an investment, because it doesn't move. And so this is a famous quote by Mr. Warren Buffett, one of the most celebrated. It will remain same while the other assets will go up and down. So to answer this question is, answer is yes, it's an unproductive asset which doesn't produce, but it is an asset which has a faith of the whole humanity for maybe 5,000 years or so. There are wars which are fought for gold. not for land, but for gold or so. So gold is an antithesis to so dollar is an unproductive asset. Dollar treasury is giving you a 0.5% yield today, just 0.5% yield. And the world central banks, including India, with $550 billion of reserves, owns $400 billion of dollar reserves because it's a currency of the trade. So the gold is also currency of a trade. Gold also has a unique feature where it is a wonderful asset when you have the world which is going into chaos. So in that context, gold does play its role very well. And because there has to be a standard where the gold would have been, the gold has got more relevance since the dollar depegging of the gold has happened. So whom do you measure against? It's a standard of measurement. And once you have other competing assets which are losing their value, then you have a standard which really does plays out. And your second question was regarding the inflation. So you have today a situation where I did made in our conversation and the presentation is that we have a negative interest rate scenario, real negative interest rate, which is important, real, not negative, real negative interest rate scenario. And look at the situation where if next 6 months, because of the huge printing of money, which has happened now, 50% increase in central bank balance sheet in a span of 5 months is a significant number. And in that context, as the COVID situation recedes and the economy will go out of the lockdowns, if you don't see a situation where the central banks are able to reduce the balance sheet, then I'm sure there is no reason for you not to get worried about that inflation is coming or not, because the velocity of money which has been increased in the financial system, which is in the system and which has gone into the financial assets, not to the real economy. With the $1 trillion, America has not made the roads or any other real economy work. So you have a situation where the inflation will come back again in some form or others, and we have seen many times. So until you are convinced that the central banks will roll back the monetary stimulus which has been given in next 6 months, 9 months or so, if that is not happening, then the inflation is coming back in some form or others. Today, the inflation expectation is 1.2% as per the TIPS, which is the Treasury Protected Inflation Instruments. Linked and if the inflation is above that, then definitely you will have a situation where either the interest rate cycle has to go up substantially, or we will be into real negative interest rate scenario for extended period of time. And gold loves these kind of situation, as we also mentioned in our conversation and our charts.
So why is it gold is considered as a hedge against inflation? Is there a fundamental reason to it, or is there its history behind, and that's why we kind of consider it as a hedge against inflation?
Very interesting question, Puneet. It's not about gold. If you bought a Leonardo di Salvator Mundi painting, which is worth $450 million, I think in a span of 400 years, it would have given you a better yield than the asset. So you need an asset. By the way, for the audience, let me tell you an interesting thing. It's not the gold which has given you the highest return in 20 years. It is the platinum and palladium. If you look at those values of those commodities, which has got an industrial use as well as in short supply, they have given you wonderful. The reason these commodities which are in short supply, or anything which is in a short supply, is an antithesis to inflation, because inflation eats away your money. Inflation eat away, as a bond investors, you are poorer going forward when you have an inflation of 3% or 5% or so, unless until you get compensated significantly in those kind of bonds, and which is not the case. Most of the world is a fixed return bonds. So in that context, you are losing money. So the world will trying to, or investors will trying to find an asset where you will not lose money, and that is a gold over a period of time. Not that the gold doesn't give you a negative return. Between 2013 to 2018, the gold went up to $2,000 to $1,300 and stayed there for a long period of time, because there was an alternative where the money was made in US Treasury versus a gold. So the reason is that the people want to find an asset where there is no leakages in the system, or the purchasing power is not reducing, and that's why the inflation come into play.
So perhaps a vintage wine, or maybe a vintage whiskey,
yes,
or a painting, all probably fit into that bracket, right?
Oh yeah. So I am not a wine lover, so I would look at gold.
All right. There's another question. That's probably the question which is on everybody's mind. Where do you see gold in terms of prices in next 6 months to 1 year?
I would be extending my human capabilities to give you a price target. But I did make this comment that how far and how long, and how far and how long has got, these two words have got an important meaning. That I see a situation where the world will have a difficult times in wriggling around to increase the interest rate. So you don't have a situation where you can increase the interest rates significantly. So if you don't have the situation, and we are into, because of the budgetary deficit in the world, the fiscal deficits in the world, you are into a situation where the interest rates are going to remain low because the governments are the biggest beneficiary in the system. And then if inflation has to come, then we are talking about another year time frame or so, where these kind of assets will have the merry-go-round for a considerable period of time. Whether the gold settles at, did I realize that in a span of 9 months, gold will go from 35,000 to 55? Answer is no. Answer is yes, directionally I wanted to hold that asset. And I would say that you need to hold this asset till you find that the interest rate cycle have started moving up substantially, and you have moved into a positive interest rate territory. And as my chart explained, even you are late by 6 months where the interest rate is a positive, real interest rate is positive, you will still make a lot of money. So directionally, directionally what I can tell you is that there's a lot more money to be made in gold.
So by lot more, you mean, could you mean 40% from here, or 50% or 20%?
So Puneet, the problem is that it's not a security where you can do a discounted cash flow method, and you have more competing securities which you can say that this is, as an equity investor, you can say this is a 10p multiple and it cannot go to stratosphere, or it can just go to 15% here and there. So you don't have a real economic model which can say that how far the gold can go. And in that context, you can only look at the time frame. And I'm far more convinced about the time frame that it has got a one more year of rally to go. Whether this will stay here for some time and then, so usually gold works in spikes. Gold doesn't work on daily basis. It's not a compounding machine. It works in spikes. So when you have these kind of situation, it will give you 40-50% return, and then you'll go back and sleep.
So an interesting thought which just came up in the chat box. A gentleman says that, well, why even bother about what the price of gold is going to be 6 months down the line? If it doesn't work, at least your wife is going to be happy. So that's a nice thought.
Yeah, that's how India has built its reserves and built the Indian households have got a trust on the gold, which has been there for maybe 2,000 years or so. And we have one of the largest gold reserves in the hands of household. And more and more reserves I would see now will go into the financial market looking for a gold as a proxy. So I think I would agree with the observation.
So Shivanshu, there are a couple of questions that are technical in nature and related to MCX. One of them is, what does LBMA mean? And the other is that how can we take delivery from the exchange? Could you throw some light on that?
Yes. So I'm sorry, I missed the first portion of your question. The second portion is
LBMA mean?
Okay. So LBMA means London Bullion Markets Association. It is the international standard. It's actually a quasi-regulatory body. It is which runs the standard for gold in terms of not only the product quality but also the refiners' abilities, refiners' processes, audits of responsible sourcing guidelines, etc. So it is a respectable most authority. It has about 70 to 80 refiners who are accredited with the LBMA accreditation. So which is what is a quality benchmark basically. So we have maintained the exchange standard there. Of course, there is a plan to expand this now going forward to include the Indian local refiners, because now the BIS has come up with the India Good Delivery Standard, which was long awaited. But of course, with a very stringent process which we have put in place, which includes all those tenets which I just mentioned of the LBMA. So maybe the most stringent audits who passes, those refineries may also find their way at equal, at par in this contract. This is still under the works and subject to further regulatory approval. It has reached somewhere, but further, yeah.
And
Now, second question.
Yeah. How do you take delivery of bullion from the exchange?
So you see, it is basically all our contracts come with a delivery and tender period towards the end. In the case of the bi-monthly contracts of gold and silver, they are the first 5 days of the next calendar month when they get rolled over. For example, a September contract, 1st September to 5th September will be the delivery period, and so on. So you get 5 full days of staggered delivery at the end of each contract. Before the beginning of this last 5-day period, normally all the financial players would have rolled over to the next contract, and those who want to take or give delivery, they are marked for delivery at the end of each of these 5 days, and the settlement of that takes place the next day. By the midday, your commodity pay-in payout as well as the financial pay-in payout takes place, and it behaves just like a spot market for the 5 days. And how to take delivery is nothing. It's just like I said, the electronic process of commerce has to be, that account has to be opened. You with your member, with a broker through whom you'll be opening the MCX account, he will take care of all of those things. And ultimately, the price at which the futures closes out on each of those 5 days, and on the 5th day, it is the DDR. So every day on the first 4 days, it is the DOR, delivery order rate, which is the last half an hour average of the trades. And on the last day, it is the previous 3 days spot price, which is averaged and taken as the DDR. For all practical purposes, it's a futures market with a compulsory delivery logic. Whatever price at which you have bought is going to be the price ultimately at which you take delivery. Rest of it would anyway be M2M, as you're aware. So that being said, the lower contracts of gold mini, they are deliverable on a monthly basis. And so also,
I'm sorry, I'm stopping in the middle. So where do you actually take the physical gold delivery from? How does that work?
Yeah, so we have exchange accredited vaults at the basis center as well as additional delivery centers. So those vaults are all the 3 leading vault service providers like Brinks, Sequel, and Malka Amit are already accredited by MCX as the exchange approved vaults. So if somebody has to take physical delivery, they have to take it from that vault location and move it from there. If you want to just hold it as the Comrisk electronic credit, you can continue to hold it, and as and when you want, you can get it dematerialized whenever you want to move it out. It's like that. Physical delivery takes place in a very simple rematerialization. There is no complication. It is maybe half an hour process, as well as the like I mentioned, the delivery centers for the big contracts of gold and silver. The basis centers are Ahmedabad. We have also added additional delivery centers, 7 more in both the cases, which are on intention matching basis only. So if somebody wants to give delivery in, let's say, in the big gold contract in Chennai, and somebody wants to take it, there's a window available on each morning of that tender period in the morning itself. At the moment they both match, then that delivery can consummate at the non-basis center also. So this is how it works.
Fair enough. Fair enough. Thank you so much. So Manish, here is a couple of questions towards you. Can gold be used for goal planning? So you have a defined goal to achieve, let's say over 10 years. Do you think gold as an asset allocation fits in somewhere in a portfolio like that?
One of the most important aspects for any asset class, whether you talk about gold or equities or leave out debt, maybe some point of time in debt, is your point of entry. So if you are excited today about a gold, then you need to say you have
We lost you there. There's some internet connection issue.
Okay, so I was making a point that each asset class has its own flavor of the day at some point of time. So if you are looking at gold as a very long-term asset class, maybe you want to do an SIP for 15 years, 20 years in a row, yes, answer is yes. But then if you want to look at a period when again the gold as a real interest rate returns goes up, the real interest rate cycle changes, then you will have a flat period of gold. That's not a gold is not a compounding machine. You have a time frame, and gold has not given you a return between 2004 to 2007, 8, and then it again gave you a return of 50% in those time frames. So my objective here was to define those time frames and look at those time frames more closely and make more money on those time frames. And then really you need to judge what you want to do beyond those time frames. So at least for 1.5 year or 1 year time frame, you have a runway. And then if the cycle interest rate cycle changes in the situation and you have a positive interest rate scenario, then I don't see the gold will give you a return. So you need to decide accordingly.
A very interesting question. We know the state of gold right now, and we kind of have built great expectations from gold over the next 1 year or so. And we also know the state of equities right now. So do you think gold and equities can both rally from here? Of course,
I thought, yeah,
assumption.
we made a whole an hour time frames to talk about that what is going in for the gold. And I said directionally it looks good at this point of time, and at least for a year or so. Can equity do very well or so? Answer is yes. That's the reason you have seen this kind of very sharp recovery, which has startled, I think, 99% of the investors. That why there is such a sharp recovery in a span of 3 months when we saw one of the disastrous time in month of March. So the reason also lies in the decline in the US dollar, DXY, which has changed its shades from 105, 104 back to 93 or so, where the concentration of capital happened in the US dollar for last 10 years. And now you are seeing a dispersion of capital ideally should happen from the US dollar to other asset classes. And in that context, yes, Indian equities also are a gainer and would gain. So the limited point I want to make here is, if I look at the macro situation today, I don't see that the equities will go for a tearing downward movement, at least for some more time, unless until the dollar changes its shade, and I don't see that is going to happen. So you will see equity will remain buoyant, whether the XYZ company will give you a return, or whether a basket of those companies will give you a return. The styles will change. Mid caps have done well. Large caps may struggle for some more time. So those combinations will keep on playing here or there. But the financial market will remain buoyant for some more time to go.
And so a follow-up question on that. We are bullish on gold, and we are largely a player in equities as far as Vallum Capital is concerned. So have you invested in gold in your portfolio?
Yeah, that was I was referring to that 2 years back. We became bullish on gold 2 years back. And we wrote very detailed thesis on our shareholder letters in 19 and 20, both 2 years. And what we did as an equity investor, we looked at and we scanned all the opportunities which is available to an equity investor as a gold. And we bought a gold-linked gold loan companies as part of our portfolio allocation. And that was the best hedge for us, where they gain because they are like an ATM machine where the price of the underlying collateral goes up. So you have more money which can be redeemed by their people who are seeking loans in the process, and their assets become quite I mean to say exciting enough and default free in the process. So we did that as a part of our equity investments.
But why not gold ETF directly or a gold mutual fund as a part of the asset allocation?
No, we don't run an asset allocation fund. We run an equity fund. I have my own limitations.
Okay. So there is a question, Shivanshu, probably you can answer it. What is better, a gold ETF or a sovereign gold fund or a gold bond, sorry?
Yeah. Am I audible?
Yes, please.
Okay. No, so basically, every product has its own features as such. The benefit of ETF would be that, it is probably for an investor who already has an equity portfolio. He just wants to diversify by this way, and there is no leverage, convenience of leverage there. Premium discounts can vary. Liquidity is about okay. It is physically backed, yes, but when it comes to sovereign gold bonds, liquidity, it seems, is an issue in terms of secondary market in a big way when you're trying to go and sell it. At the same time, it has a yield to it, which is probably something which gold normally doesn't carry. It's paper gold, of course, and at the same time, if you hold it till maturity, I believe that the taxation benefits accrue to you. But having said all these things, if you compare this with futures, what we've been talking about, the advantage there is capital efficiency. Okay, it is against a margin, you're getting a full position. At the same time, liquidity of the order book of the exchange is something which is specially available there. There is less disparity in terms of, you often hear that ETFs are prevailing at a long time, they keep prevailing at a premium or a discount. Here, the disparities may come and then they may go. So the liquidity of the order book takes care of such disparities from time to time. Physical players are also active here, along with the other types of players. So on an absolute return basis, the employability of direct capital in futures is direct, as you are aware. The others have certain, cost nuances, asset management nuances of their own, and the liquidity. So different things make different sense to the type of investor who wants to trade more, who wants to utilize his capital, take advantage of sudden moves and spikes. And of course, liquidity, when I say futures, so in futures, if somebody is an investor, then he can do a weighted average much better than any other product because of the liquidity and because of the time frame of the futures, as well as the delivery leg and electronic holding being enabled. So it takes care of trading as well as investment. Thanks.
Fantastic. So, Rishiji, if you may, I think we have taken a lot of time for each participant here, including panelists. Should I move towards the closing of this particular webinar, if you may permit?
Yes. So it has been a very informative webinar and a lot of relevant questions, a lot of views shared, especially by Mr. Bhandari and Shivanshu. And I hope it has been very informative to the audience, and starting very late due to the technical glitch, I hope we are more than made up by the excellent insights we've got in this webinar. So thank you all so much, and thank you having us in this event, and thank you Mr. Bhandari, and thanks Shivanshu for joining us.
Thank you.
Thank you and good day.
Thank you. Bye-bye, everyone.
Thanks a lot. Thank you, Mr. Rishi, for hosting.
One last thing I would like to say. If any of the participants would like to know more about any of the queries which could have been missed, you may please connect with Vallum Capital or MCX or mastertrust anytime. Thank you very much.
Yeah, thanks. For some strange reason, my video is, I believe, not reflecting, but I thank you all for the participation and a great session.